Good morning. I'll start by explaining the accent, because otherwise you're going to be worrying about that all the way through. So I was born in New Zealand. I grew up in the UK. That makes me half competitive and half cynical. Interestingly, both countries seem to take pride in that. I think competition is great, but one of the ideas that I'm going to be talking about today is that we're moving from an era of competition to an era of collaboration. It's always useful when the speaker before you describes strategy as competition, but I actually don't think those are different ideas, and I'll hopefully over the course of the next 35 minutes I'll share with you some ideas on how you can use that. So we've talked about my bio. I've been lucky enough to interview about 500 business owners and leaders in Asia. I've learned that I look better in black and white. I've also started, built, and bought and sold a number of businesses. I've made pretty much every mistake going in the process of doing that. Actually 2 or 3 times. I'm a bit of a slow learner when it comes to that. But I have discovered that we are definitely moving into this era of collaboration, and hopefully you can take away some ideas around that. Typically, when I'm speaking or when I'm writing, I'm focused on business growth, and I focus on these 3 areas. So building assets in your companies, leveraging them through alliances, and then growth or exit through acquisitions. When I'm talking to business owners, typically building assets is around building a product ecosystem. Most of you already have a product ecosystem in your business, so I'm going to take a slightly different slant on that today. I'm actually going to skim through assets and alliances very quickly, and I'm going to focus more today on acquisitions. And I'm going to share with you a particular collaborative approach to mergers and acquisitions, which is quite new, and I think it's going to shake up the industry quite a lot. Specifically, it's a collaborative approach to IPOs, so I'll move on to that. Stefan's just done a brilliant job of talking about the disruption that we're all facing, so I'm not going to go too much into it. I think everyone's aware of that. We've got huge demographic shifts going on, especially in Asia, but globally we've had this shift from rural to urban communities. We have the demographic cliff happening, especially in the Western world. You've got the technology shift that's just growing at an incredible pace. You also have this shift, which a friend of mine, Daniel, describes as the entrepreneur revolution, which is a shift from big faceless corporations to smaller, more nimble businesses. Now, the problem with smaller, more nimble businesses is that oftentimes they don't have the resources to compete with the big faceless organizations. And that's where collaboration comes in, because if they can collaborate, then suddenly they do have that potential to grow. I threw this in at the last moment because I read it over breakfast yesterday. I'm not sure if you have AXA here in New Zealand. When you start thinking about collaboration, actually you start to see the signs everywhere. And it was interesting to see that the CEO of an organization that big is thinking about collaborating with small businesses. So when we talk about assets, I think for this audience, what I want you to think about more is about the assets that are already in your business, and specifically people. I was the co-author on a report called the Faceless Report. I'm here all day. If you give me a copy of your business card, I'll send you a copy of this if you're interested. It was basically this idea that we are living in much more transparent times. Your consumers want to know who is in the organization. The faceless corporate is disappearing. And so at every level of the business, you want to have people that are communicating, people that are building influence within their community, not just within the business. So we're all familiar with CEOs coming and standing up and talking at an event like this, but do you have your HR managers talking at HR conferences? Do you have your procurement manager writing in Procurement Weekly? I don't know if that's a thing. But at every level of the organization, you've got really smart, talented people. They're very good at what they do, but with some soft skills, they can actually become much more influential in the industry. That leads to attracting smarter people that want to work with you. And it's these 5 skills. So understanding how to articulate your value. Most of us do a terrible job of doing that. As you're networking today, I'll ask you to be aware of that. How do you create value in the world? How do your employees create value in the world? Publishing content. All of your employees have got this incredible intellectual property in their brains, but as long as it's in their brains, there's very little value on your balance sheet. If you can get them publishing content, it has a huge impact. Just an example that I've thought of recently, we had an events company similar to Conference, not as big or successful, but and our event manager knew every venue in town, and he had that information on a spreadsheet. He realized that actually if he published that information, that he could provide value to all of the other people that are out there trying to organize conferences and events. Now, arguably, you could say, well, that's, or you could not, okay. You could say that's our IP, but when he published that content out into the world, what happened was people started contributing to that. People started suggesting new venues that he didn't know. Venues on that list started offering us freebies to come and do events with them so that they could improve their rankings. So once you start to take a bigger picture and start focusing on the industry, it grows very quickly. You can then take that intellectual property and productize it. It can be in the form of book, or it could even be just internal documents within your business. But that IP starts to be something that you can actually show on the balance sheet. Profile is the bit that everyone worries about. If I raise my profile, am I going to get abuse? Am I going to be the next soap opera star? Profile isn't about being high profile to everyone. Profile is just about being known within your industry to your target client, whoever that is. And the final one is partnerships. It's understanding how to leverage your value in a way that creates value for others. And I'm going to go into that in a little bit more depth. So the idea that we have is that everyone in your organization is already standing on a mountain of value. The challenge with standing on a mountain of value is that it's very difficult to see your own mountain of value. What you find is the most influential people in any industry, in any niche, are not necessarily any smarter than the rest of us, but they're just very, very good at packaging their mountain of value in a way that creates value for others. So once you've created that value, how do you leverage it? For me, it's always about partnerships. I have just written a book called Progressive Partnerships, The Future of Business. I've been accused of being lazy because if I can find a partner to do the work, I will always, always partner with someone else. In fact, I've done some work with Google, and that is their first question. They have their moonshot labs in Silicon Valley. The first question they ask when they innovate something is, who can we partner with that can make this work better? Now, if a company with the resources of Google still asks that question first, why isn't every business asking that question? So one of the principles that I kick off in the book is this idea of the illusion of limited resource. We all have this idea that there's not enough customers, there's not enough good staff, there's not enough cash, there's not enough whatever it is. And actually, I would argue, and Stefan's just made this point, is that it's an illusion. We live in a world of abundance. Whatever it is that you're lacking in your business right now, somebody somewhere in the world has woken up with an abundance of that, and if you can partner with them, the two of you can be stronger. The reason that I find a lot of people struggle with this idea is that everyone I talk to has got a history of failed partnerships behind them. Everyone's tried these, they've gone into with good intentions, but the partnerships have failed. When I was building my businesses years ago, I didn't have any resources, I had to use partnerships. I had the same experience, most of my partnerships failed. So I developed a model which assumed that partnerships will fail, and you can still be successful as a result of it. Obviously, you can't be an author these days without having a 5-step process or a 7-step. So I have to sit there with a thesaurus and come up with this. Let me give a very quick example of how this works. 10 years ago, I had a small business, again, running conferences and events like this. There was a property development company in our city that was spending a huge amount of money on marketing. We wanted some of that marketing budget in our pockets. but we had no vehicle for it. We didn't know anything about the property industry. So we decided to create a networking event for property professionals and try and get these guys to be the headline sponsor. Had we gone to them directly, they would have laughed us out of the building. So we had to use this progressive partnership model, which is basically the idea that you do partnerships, but you leverage that partnership to do the next partnership, and you leverage that partnership to do the next partnership, and so on, which means that even if any of these partnerships don't work out how you intend, you're still getting the value because you're moving up the ladder. The way we did this is we did a quick search, and I was in Bangkok, Thailand at the time. There were 2 property magazines that were available in Thailand at the time. One was really good, one wasn't. So we went to the one that wasn't very good. We phoned them up, and we were looking for a deal they couldn't say no to. So we phoned them up, and we said, look, we're starting this property network. Would you give us 30 back copies of your magazine that we can give away? Every magazine's got back copies that they want to get rid of. So they said, yeah, absolutely. So we had our first media partner, and we had 30 rubbish magazines. But at least we had some traction. We then took those magazines, and we went to a pub. There's a reason for this. Went to a pub to read the magazines, and we said to the bar owner, we said, look, we know this pub is normally very busy, but I've noticed on a Monday night you're empty. We're going to hold this networking event. Would you like us to bring 30 property professionals once a month on a Monday night? If it's a problem, we'd love to go to the bar opposite. He said, no, that would be great. In fact, I'll give them a house pour. Everyone that comes in gets a free house pour. So, great. Our next step was we looked through, we saw who was advertising in those magazines. We found a real estate agency. We didn't have any people that were going to attend this event at this point. So we went to the real estate agency and we said, look, we'll give you a year's free sponsorship of this networking event. You'll get database, you'll get logo, you'll get banners, you get all that good stuff. And your 30 staff will each get tickets, free tickets to come along, and they can bring 1 guest each. And at the end of that year, if you've had value, we'll sell you sponsorship for the following year. If you haven't had value, you can just walk away. Very, very easy for them to say yes to. Actually, we didn't care whether they renewed at the end of the year. We just wanted to have those people coming in. So we kept bouncing up this ladder. We went to interior designers, we went to furniture, we went to any number of companies. After about 6 weeks, we had a huge number of contracts, but we didn't have any money. And then we got the phone call we wanted. Henry, the marketing manager from Raymond Land, phoned us up, and he said, for the last 2 weeks, every meeting I've gone into, your name has come up in relation to this networking event. How have I not heard about this? I said, oh, Henry, look, I'm really sorry. We've been very busy dealing with blah, blah. And he cut me off. He said, how do we get involved? I said, there's only 1 sponsorship slot left, but I'll send you the contract today. If you sign it, you can have naming rights for the year. He signed the contract. We made about $50,000 pure profit on that. And interestingly, I end it with expand. And expand is just taking it up 1 level. One of the things that we had discovered in 6 weeks of meeting with everyone in the property industry was that we didn't actually like that many people in the property industry. No offense to anyone in the property industry. It's a different country. And we didn't really want to run that event. So we had an event that had all the sponsors, we had all the people coming, we had media partners, we had now cash as well. So we just bundled that up and we sold that to somebody else that was in the industry and wanted to build their profile. It's a very small example, but it's a great way to leverage partnerships through collaboration to build up. If you want it does sound overcomplicated, but that's when you're a small business, you're under-resourced, it's useful to do that. You can buy the book on Amazon, but I'd recommend you just download a free sample from my website. Acquisitions. I want to talk about an idea called agglomeration. And agglomeration is really a hack of the traditional roll-up model. My business partner is a guy called Jeremy Harbour, who's considered one of the thought leaders in small business mergers and acquisitions. And this idea evolved primarily because both of us had tried to sell numerous businesses. And it may surprise you to know the market never valued our businesses quite as highly as we did. What I think there's a lot of talk about innovation in startup and in financing of small businesses. There's not much talk about innovation at the other end, and this is really innovation at the other end, and I think what the implications are actually going to be very huge for small businesses, and I think because they're so huge for small businesses, that's going to have an impact on bigger businesses as well. There is a hysteria around startups at the moment. I know you've got a bit of it in New Zealand. In fact, every single country in the world is trying to position themselves as the next Silicon Valley. The governments are chucking tons and tons of money into it. Everyone's proudly running around calling themselves startups. I used to be invited to speak at a lot of startup events, and then I wrote an article that said, stop calling yourself startups. The hardest thing in business is to have credibility. The minute you define yourself as a startup, you lose all credibility. Yet this weird little ecosystem has grown up around Silicon Valley, and so everyone's proudly calling themselves startups. I don't get invited to startup events anymore. But the interesting thing is you've got all this focus on, and it's basically gambling on lots and lots of startups in the hopes that you're going to get a unicorn, which in many cases is just a horse with a pointy valuation stuck on it. But actually, if you can find good small businesses that are doing $1 million in revenue, they've already found a problem. They're already solving that problem. They've already got good staff and they've got good customers. If you can help that business go from 1 million to 10 million, you're pretty much guaranteeing 20 to 30 new jobs. There's much more value for the society in terms of doing that than there is in often betting on these startups. That's why I don't get invited anymore. The other thing that I think is worth exploring is this entrepreneur delusion. A lot of people are jumping out of really good jobs to join these startups, to become entrepreneurs, and they have this idea that in 3 years' time they're going to sell their business for millions. I call this the entrepreneur delusion because the data just doesn't support it. In the US last year, there were 26,000 small businesses sold. The average price for those businesses was $260,000. It's really depressing. And those are the businesses that are good enough that actually get to a point where they can sell, and they sell for $260,000. You then split that between however many partners are in the company. You're not retiring on that. So there is a bit of a delusion around the entrepreneur dream. Fundamentally, there are kind of 3 reasons why small businesses get such poor valuations, and this was the problem that myself and Jeremy were trying to figure out. So the first one is risk. Small businesses are inherently risky. Even the best ones are typically only 2 clients or 2 key staff members are leaving from having their worst year ever. Investors will factor that in, so the prices are low. Not many opportunities to get a slide of animals mating into a presentation, but my first business partner always used to say to me, elephants only mate with elephants. I could probably find a more appropriate picture, but anyway. Small businesses face what we call a scale paradox. As a small business, under-resourced, you can't go for those big contracts. Because you can't win those big contracts, you remain a small business. In fact, oftentimes what happens is another big business will win that contract and then outsource the work to you while creaming off most of the profits. So small businesses get stuck in this scale paradox. And the final one is liquidity. If you have ever invested in a mate's business, as I've unfortunately done a few times, you'll know it's nearly impossible to get that money out. Small businesses are incredibly illiquid. And so consequently, investors will punish those businesses in terms of the valuation, which is why myself and Jeremy were getting lower valuations. We knew that we had good companies, we knew we had great staff, great customers, but because of these 3 factors, we were getting low valuations. Then you've got the other things like demographic. There are less people out there to buy the business than there used to be. In fact, this demographic cliff, there's 12 million businesses in the US right now, and the US has just got better data, but extrapolate out for most Western countries. There's 12 million businesses. 8 million businesses in the US are owned by baby boomers. Baby boomers are retiring at a rate of 10,000 a day. So there's an estimated 8 million businesses are going to come on the market over the next 5 to 10 years. If the average price right now is $260,000 and you flood the market with millions of new businesses for sale, what's that going to do to the price? The other problem you have is that nobody's buying businesses anymore because it's much cooler to start up a startup, and it costs nothing. You can start up a startup as a side business. You can have global reach and all of these other cool things for $100. Why would you invest a ton of money in an existing business? That now seems risky. So valuations of businesses are going to plummet. So we came up with a model called the Agglomeration, just because it's difficult to pronounce. The Agglomeration, in effect, is a collaboration of entrepreneurs to IPO. It's a collaborative IPO. What happens is you bring together, say, 20 businesses from the same industry, geographically diverse. You take that group of companies and you list that company. What that does is, from an investor standpoint, you minimize risk because you're now investing in a portfolio of small businesses. For the companies themselves, they get over this scale paradox because when they want to be a small, unique company, they can be a small boutique company, but they can also point to the balance sheet of the whole group. So when they want to be a big company, they can be a big company. They can now bid for those bigger contracts and cut out the guys in the middle. They also have sister companies around the world. A lot of small businesses try and raise money to go and expand into new countries. It's a very, very expensive way of doing it. You typically make a lot of mistakes. The first year is very painful. If you have a sister company in a different country with a vested interest in your business, it's much, much easier to expand. And the third one is because you're an IPO, you're now in a full liquid environment. For a business owner, that's very exciting. That means that rather than selling your business being a binary event, you can now sell a little bit of your business and buy a house. You can attract senior staff to work with you. Most senior staff are pretty skeptical about earning private stock, but public stock that they can see their value go up and down, they can trade it, is very different. So you can suddenly start to do a lot of things with the liquidity that brings you. Finally, you can use it for acquisitions. You basically have a new currency which you can use to expand. Being that we're sort of now in a mergers and acquisitions space, our answer to everything is acquisitions. If you want to move into a new country, acquire somebody. If you want new staff, acquire somebody that's got those staff. It's a bit of a one-answer-fits-all solution. The reason why this is slightly different from the traditional roll-up model is what we've discovered is that the traditional M&A space, the traditional roll-up model is very ego-driven. It's very much, I'll buy your company because I love your company, and then I'm going to insist on putting my logo over the door and imposing my best practices on you. At which point, you, the founder, leave, take your best staff with you, and I've just destroyed half of the value that I was buying in the first place. This is about a collaborative IPO. In effect, what we do is we bring the CEOs, the founders together. They're part of this group. They're now owners of this group, but they've got no say over anybody else's business. They've still got full control over their own business. We obviously come from an entrepreneurial background. As entrepreneurs, we were never particularly good at taking top-down management. So we assume that the entrepreneurs that we work with will equally have problems with that. So we leave them in full control of their business. It's their brand, it's their hiring decision, it's their budgets. But you have them in this group. Once a quarter, they come together to talk about the stock price. They can't talk about how anyone else is running their business. They've got no say over that. So that's where they start to look at the synergies. Most people, when they do M&A, they obsess about synergies. We don't obsess about synergies. The value increase comes from being part of this group. You can double or triple the value of your business overnight by joining one of these agglomerations. This is an example of one. Unfortunately, I had to remove the numbers from the big bubbles because we're currently in the quiet period. This is a group of marketing companies that we are listing later this month. We're listing them in Europe, but we've got companies in the UK, Singapore. I'm actually meeting with a company here in Auckland tomorrow that's joining this. In effect, what happens is we list with a small number of companies, and then we reverse in a next group of companies, and then we reverse in a next group of companies. So by the end of this year, we will have around 20 to 30 marketing, digital, video production companies around the world in this group. Without mentioning numbers, we'll be about the same size as an MNC Saatchi, but we'll have achieved it in 12 months rather than 28 years as they have. If you were doing traditional M&A, you would get massive, massive indigestion from doing that as you try and merge the cultures and the systems and all of that sort of stuff. Since we don't need to do that, actually, you've got a very, very scalable model. The companies, of course, will start to collaborate with each other, but the model's not predicated on that. Even if every company remained completely siloed, didn't talk to each other, you would still get that massive uplift in value. It basically unlocks the value that's already within those businesses. Why are we doing this? So I mentioned that we were trying to solve a particular problem, but there's actually, it's unlocked a kind of a bigger idea. When we spoke to a lot of investment banks, a lot of private equity, and one of the things that we kept coming back to was there's a general belief that you need to keep entrepreneurs poor. Entrepreneurs basically get shafted at every level. It's the entrepreneur that mortgages their house to pay wages. It's the entrepreneur that is the last person to get paid on an earn-out. And the belief is that entrepreneurs need to be kept poor, to be kept hungry, to work hard. We actually have a very different idea about entrepreneurs. We believe that entrepreneurs are fundamentally problem solvers. And if you can give them resources, if you can give them liquidity, then actually what will happen is that they start solving bigger and bigger problems. Ultimately, what we believe is that once you've solved enough problems in your business or in your industry, you start playing a bigger game. And if you look at philanthropy right now, what you discover is most of the interesting stuff that's happening in philanthropy is being driven by entrepreneurs, not by charities, not by NGOs, but by entrepreneurs that are going out there and making change. And it's not just the old fellas. Zuckerberg this week announced that he wanted to change the structure of Facebook so that he can sell all of his shares yet retain control. That's because he wants to give 99% of his wealth away in a way that helps humanity without keeping control of it. Sean Parker last month announced that he's donated $250 million to creating an IP-free platform for cancer researchers to share their research from around the world, and he's protecting that. One of the scientists involved says that he reckons that's forwarded cancer research 100 years by providing that platform. So we believe that if we can help entrepreneurs to get more liquidity and grow, they're going to solve bigger problems. So I think that's quite an innovative approach for collaboration, not competition. It does. One of the things that often comes up with entrepreneurs that we speak to about this is, yeah, love the model, get it, love to triple my value overnight, that's brilliant, but I've got one competitor and I hate them. So I'll work with every other company, but just don't bring this one competitor into the group. The way we run it is through a constitution, so everyone gets a vote on the board. And we say, well, it's just going to go to the board. Like, does the board will this add value to the stock price? And actually what you find, it normally takes a couple of drinks, but what you discover is that when you think about this with a collaborative mindset and not a competitive mindset, you realize that actually you'd much rather have your competitor in the group, because if you two both go and bid for the same project and your competitor wins, your share price still goes up. You don't actually have to do the work, which is quite a nice place to be. Also, wouldn't you rather have them in the group than outside the group? So suddenly there's this incentive to start thinking much, much bigger, which allows everyone to grow faster. If you're interested in that, we have a white paper on it. Drop me an email. Happy to talk about that. And like Joe said, I'm back here for questions, or take questions now, and I'm here all day if anyone wants to talk about it.